we can absolutely buy anything that we want to buy. Like that was the realization with creative finance. It's you can buy everything. The discipline is not buying everything. But you can buy absolutely anything if you structure the deal.
Hey everyone, today I have Chris Osgood and
Christian.
And we're going to talk about how to do deals in the current market. And I'm excited to have you on, Chris. How are you?
Dude, I am doing fantastic. How are you?
Doing good. Met Todd Napola today, so it's been a great day, and I can't wait to meet you. Get to know more about what you're doing. So, how'd you get started?
So I got started in real estate. I wanted to be in real estate since I was a kid. One of our neighbors used to renovate houses. Retired really early from his banking job, and I was like, oh, that sounds awesome to have that freedom. So I'd always wanted to, but it took a really long route to get there. Went to college, got sales jobs, eventually started working for land.com, which was acquired by CoStar. Went from apartments.com through the whole CoStar LoopNet platform, and got to a point where I was 28 years old and I still didn't own any real estate, which didn't make a lot of sense. So I was in real estate, not investing. 2020, when everything shut down, I just kind of had a wake-up call to I'm still not doing what I wanted to do. So I bought a duplex, just one simple duplex, did really well, bought a second duplex, and got to the same issue of okay, I'm buying properties, but I'm not scaling very quickly. Like, this isn't financial freedom. How do we go bigger? Next deal I bought was with my business partner, Cody Davis, and it was a 38-unit apartment building. And since then I had typically buy something, seller financed, about every 45 days or so.
That's incredible. So tell us about your first deal. I mean, the 38 unit. Tell us.
Okay, so first larger multifamily deal. $2 million purchase price, had been on market for 13 years at that price. So when people go like, oh yeah, there's no deals to be found here. Literally anyone could have found this deal online anytime. This was advertised. It was easy to find. There were some problems with it. One of the roofs were bad. The septic wasn't great. And there was a homeless camp on the back of the property, and collections were terrible. So you had a not bankable property that was absolutely, it was listed as seller. I don't know if it was listed as seller financeable. It was an easy question to ask, where are you willing to carry a contract? It's obviously the only way it's going to trade, because a bank's not going to lend on that. That property itself, we bought it. 11 months later, it appraised for $3.6 million. We refinanced. We've refinanced again since then. I've owned it for 2 years. And the last valuation was at $4.1 million. So that deal by itself, my business partner and I owned it 50-50. It made us each $1 million in equity buying that property. So that's the first deal we did. And we've done a lot of deals since then, but I mean, that's a perfect example of a deal, seller financeable, on market. We bought it $0 out of pocket, and it made us both millionaires.
Yeah, that's an amazing deal. So it was 0% down. What was the interest rate?
15% down.
15.
However, not out of our pocket. That was we didn't have $300,000, so $2 million purchase price, 300 down. We raised it from this first capital raise I ever did. It took 4 phone calls, and 3 people came in with $100,000 each.
Yeah.
They had an equity position we each had a 20% equity position. So there's 5 people in the deal, which in my opinion is too many. But again, we're figuring out how to play the game. We bought them all out in month 6. So one of them we cashed out. The other 2, we converted their equity to debt. And so we bought them out with a note.
Yeah, that's great. So there was 5 of you. What did the 3 people get as in equity?
20% each.
20%. So the 5 of you got 20% each.
Yep.
And then, yeah, that's great. And
then we converted it. Then 6 months later, we bought them out, and shortly after we refinanced, and then refinanced again.
Yeah.
And since then, we brought collections from this 38 units is making $5,000 a month when we purchased it. We brought collections from $5,000 a month to now we're bringing in $23,000 a month. And we still have, like, we just did a ton of reno. So like today, like we were almost fully occupied. We actually migrated a few tenants out of there. We currently have 10 vacancies and are bringing in 23,000. So we've almost 5x the revenue, and we're like 66% occupied.
So that still has a lot of meat on the bone for you to.
Yeah. Well, I'm like, that was bad math. We're closer to 70% occupied, but either way, yeah, there's a lot more upside to go on this deal.
Yeah, that's awesome. And now that you've done this deal, what changed in you?
Biggest change, that was a big confidence boost. You want to get big wins early, and that was a very sizable win. I think they just gave the confidence for, okay, we can absolutely buy anything that we want to buy. Like that was the realization with creative finance. It's you can buy everything. The discipline is not buying everything. But you can buy absolutely anything if you structure the deal. You don't need a bank. You don't need earned income. And so from that point, I closed on that. I work on our projects 24/7, but I haven't had a W-2 job since we closed that deal. Immediately left the projects I was working on and went full-time into real estate. That was the biggest change. I'm like, wow, if we need more cash flow, we need to buy another cash flowing deal. And that's how we do everything. Long-term cash flowing fixed rate debt.
Yeah. And now how are you structuring deals?
So today, the only property I've ever purchased with a bank loan is that first duplex.
Mm-hmm.
I have just over, I need to count them again. I'm either just under or just over 200 multifamily units.
Mm-hmm.
I have a seller financed resort. Every single one of these deals, and a lot of what we purchase is 10 to 25 units, pretty common. Every single one of those deals was seller financed. And so we're structuring deals off that principle of long-term cash flowing fixed rate debt. Every time we buy something, if we have money, we'll put it down, but whether it's money out of our pocket or not, day one it cash flows, and we have two rules. How do you buy it? How do you never lose it? The real estate needs to buy the real estate, so we structure every single deal where when the seller finance note is over, we either write a check for it or we can refinance, pull the capital back out. But when we close, our income goes up every single deal.
Yeah, that's awesome. All right, so you found this deal on market, and what got you to understand that it was a good deal?
On that one, it was the opportunity. And this is actually an interesting segue for those who are raising capital. This is how you raise capital. You identify the problems, and how you're going to fix them is the reason someone will invest. You're getting over all the objections up front. The fact that no one wanted to touch the project, but you're buying in Washington State at $55 per door, just about. In that market, average per door cost at that time was about $150 a door. So you're buying it a third of average price, but you have massive problems. The reason no one bought it is because no one wanted to fix those problems. 48 unit buildings have a relatively small buyer pool, too small for institutional money, too big for most mom and pop investors. So you have like the mid-sized multi-family guys. There's not that many of us in a given market. So the existing players wanted less project, less headache. We're newer players. I'm like, we can allocate all of our time, resources, and brain power to this property because there is $1 million to make here, but it's a really hard-earned $1 million. Like, it's a really hard-earned $1 million. For us, that was worth it to go in and do the project. Every other player, and I know everyone who's looked at it. I have a bunch of people who are like, I wish I bought that. I'm like, you've been playing this market for 20 years. You've looked at this deal 50 times. You chose not to do the deal. It's the right project for us. Because it was wrong for everyone else, we were able to come in and we're like, you know what? We're going to figure out the septic system. We're going to go ahead and fix the collection problem. Fortunately, the timing was also perfect for that. This was mid-COVID. Mid-COVID, there are all sorts of government support programs. So all the people who aren't paying, like 80% of them immediately just got caught up by government. And I'm talking like a check for 3 months of what they haven't paid before close and 3 months into the future. We're getting checked for 6 months of rent, which paid for a lot of renovation, which let us lease it up and go. So market timing was a factor, but we had a game plan. We knew we could execute, and we made it happen.
Yeah, that's awesome. Incredible how you made that happen, and it was a perfect deal. I mean, you have one of the greatest wins as you first went. So how did you, when you were talking to investors, you said you have to fix those problems, and that's the reason why people invest. First of all, how did you find these people in the first place? You said you made 4 phone calls.
Yeah, so our entire Cody and I have a website and an education program on multifamilystrategy.com. This is literally the core of what we do. Mm-hmm. Everything that you want, someone else has. Everything you want to do, someone else has done. Find those people and network with those people. That is all we do. To date, I've never actually asked someone to sell a property. I've never been the one to propose a deal. What we do is we meet people who are farther than us in our market, or who have assets that are different or cool. They've done something that we haven't done. And I meet with them, and I get coffee, and we talk about what they've done. We talk briefly about my pieces and what they do in my situation. When we get to the point where there is a deal on the table, I have all these people who I've already networked with, who've done cool things that I haven't done yet, or in a different position than me, who I actually have a relationship with. And we just called those people and said, hey, I'm looking at this opportunity. Especially when we're starting, I was like, would you underwrite this with me? Because I see possibly $2 million of upside. But at the time, I saw $1 million of upside. The fact that we got 2 was fantastic, especially because we got 2 after interest rates went up. I mean, the deal was way better than we thought. But when we were looking at it, I'm like, I see $1 million here. No one else has seen this. Would you underwrite this deal with me, or would you take a look at what I'm seeing? And we'd sit down and they'd go over it. They're like, this is a great deal. I'm like, awesome. I'm trying to figure out the money for this. Here's our position. How would you fund this? And that was generally, of the 4 people we call, 2 of them just on the spot said, love you guys, love what you're doing. I'm in. It's only $100,000. They're bigger players. They're like, we're willing to put $100,000 bet on you because you guys are exciting. The other one was someone who just underwrote the deal with us and went, I like the deal. I want to be a part of it. Let's go. That's how you raise capital, and that's how you find deals. Those same calls, it's usually not people selling their real estate who I meet with. They're usually the ones who call me and say, hey, there's a deal that's not right for me, and I think it's perfect for your pieces. You should reach out to this person. And that's how we get most of our deal flow.
That's great. How did you learn underwriting?
Underwriting, well, the nice thing is it's very easy math. It's my favorite thing about real estate. Real estate is a lot of work, but it's not complicated. When you're buying for cash flow and you're not using banks, so you're negotiating your own terms, what is cash flow? Income minus expenses equal cash flow. That's addition and subtraction. So when I'm doing underwriting, I'm looking at 2 pieces of math. Was it due day 1, and was it due whenever I have to exit my existing debt? So day 1, what does the property bring in? What are the current expenses? Or things will go up, like taxes will go up when you close, of course. But day 1, when everything is taken into account, income minus expenses equals my total cash flow. The only metric I care about, because people talk about IRR and all sorts of acronyms, there's only one I care about, which is debt service coverage ratio. I like to come in at a 1.5. So I like to know that at least half of my mortgage payment is being paid to me in excess cash flow. If I'm sitting there, I know that there's enough cash flow in the deal to service the debt and to comfortably stack away for whatever things come up. And we do a lot of reno. So we burn through that cash flow pretty quick, improving our buildings. But like learning to underwrite, it's okay, how do I write a deal in long-term debt that will cash flow at least half of my mortgage payment every single month? There's not a whole lot of underwriting that goes in past that. I mean, everything else is done in due diligence, of course. You check the bank statements, you get a feel for, what are the CapEx projects that need to go into this, and you factor. But it's not hard at all. Income minus expenses equals cash flow. You need enough cash flow to service your debt.
Yeah, it's simple. Can't get simpler than
I was just going to say, that for everyone listening, this is like the main piece. Fixed rate is so important. There's so many people who did all these variable rate projects that are getting wiped out right now. There's some big groups getting wiped out right now. That type of underwriting only works if your variables don't change halfway through your deal. So long-term cash flowing, capital letters, fixed rate, debt. Make sure you get those. As long as you know what your variables are, you've set your goalposts, and now, that's how you underwrite, and that's how you write a good loan product when you're doing seller financing.
Yeah, that's amazing, and thank you for explaining it in such a way that is simple to understand. That's like
people make efforts to make it complicated. I think it's a lot of the online gurus, which someone's going to comment on this, being like, Christian's an online guru, he has a course, whatever. But like the stupid online gurus were like, oh, I got the secret to this crazy thing. You've never seen this method before. It's like, you're buying an asset and it needs to make more money than it loses, and it needs to pay for itself over time. I need to know on the exit, like if I have a 10-year note, I need to know that I'm going to be able to refinance conventionally and pull enough money out to pay off investors or what have you. But there's not a lot of math. Like, it's super stupid simple. That is my goal always. It's like, make this simple, because it's not hard to do. As far as like the math or the underwriting, find a deal, look at the basic numbers. Is it making more than you're spending by a safe margin? Awesome. Buy the deal.
That is awesome. Thank you. And when it comes to reserves, how much did you budget, or how did you find out what to budget?
So in terms of reserves, when we started, there was none, because I didn't have any money. Is that a best practice? Of course not. But you start where the pieces are. I think a big mistake a lot of people make, because you should absolutely budget for reserves. But when you start and you don't have money, you're not going to get reserves if you don't go out and make money. And so it's not a reason not to do the deal. You just have to have more margin on the deal. So what we've done, because we had big bills due almost immediately when we closed, we had a septic problem that we were not aware of that happened 2 weeks after close, and it wasn't cheap, and we didn't have money. Turn your problems into cash flow problems. That was an easy call. I called 3 plumbers. I talked to them about our situation. I'm like, we just closed on this. I need our like septic companies. I was like, I need some help on this. I'm starting my business. I need to divide this in like payments over the next 3 months. Is there a way that we can do this? And they're like, oh, let me ask the owner. And the owner got on the phone with me, and they're like, oh, I've been there with this business. I know how you feel. Absolutely. Let's just get it done. We want your business. Super easy way to solve things. When you have cash flow, you can almost always turn your problems into cash flow problems. If that didn't work, just like we raised $300,000 to close the darn deal, it would not have been anywhere near impossible to go to someone else who's a lot further than us, who's already been there, and say, hey, I'm stuck on this situation. What would you do? And someone would have given us the $25,000 we needed to fix the thing and get it done. I'm not advocating for just ask for money on everything or raise capital. I'm just saying every problem's solvable, and it can almost always be turned into a cash flow problem. Just make sure that you have cash flow to throw at it. Because if you come in with no reserve and no cash flow, that is how you lose investor money. And that is super dangerous.
Mm-hmm. Awesome. Thank you for that. And
absolutely.
What about CapEx? How did you find the CapEx that was needed?
On this one, on that particular deal, we got a ton of government money. And that's not you look at the pieces that you have. So I'm not saying I go in and get government checks for all the past due on every deal. Absolutely not. On this deal, we got some big checks up front. Then we sold an easement to the government for to put their equipment on for a roundabout that they were building right next to our building for $30,000, which paid for 2 unit turns, which was awesome. We stockpiled all the cash flow, and then when it was time to pull more capital to do major CapEx, we had got enough in collections to where we were able to go to a bank, and they gave us a loan for $2.1 million. Now remember, we bought this for $2 million. So we got 300 down. So we got $400,000 to play with. And by play with, I mean redo roads, repair units, fix showers, make repairs to the septic, fix the roofs, change out water heaters, the whole 9 yards. We actually ended up re-siding all of the back buildings as well because they were super ugly. Now they're gorgeous. They're on this big courtyard full of trees. So I have this huge green space surrounded by brand new looking units, which again, that pushed our valuation up to 4.1, which we had more renos to do. So we did a second refi. A bummer. We went from like 4.5% to 6%, but we pulled out a bunch more money and went farther and finished the interior refi, or the renovation rather. So on CapEx, you just have to have a plan for it. It's different for every property. Sometimes you just find a great deal at a reasonable price, you get great terms, and you just raise a little bit more money, and that is your CapEx budget. But for CapEx, with everything, how do you pay for it? With money. So you either have to raise it, you have to earn it, or those are really the options, I guess. You raise it or you earn it, and put it in, and away you go.
Yeah, that's awesome. Thank you.
Yeah.
What would you advise is a good deal size for someone who's going to do their first deal?
I would go under 100 units, and I'd go over 4 units. Residential, because I started with duplexes. I own 11 duplexes, but I usually buy them in bulk now. Mm-hmm. The duplex house, even fourplexes, the residential stuff is a really slow way to scale. I know people who have on 30 years, buy a property a year, build a nice big portfolio, all in 30-year fixed rate debt. When rates were at like 3%, they refinanced everything. So they have 100 plus unit portfolios with 3% debt on. You can do that. It just takes you 30 years. In 2 years with one partner, one core partner, Cody and I have built a 200 unit portfolio that spits out $117,000 a month. Now I have a few partners in there with buyout agreements. So I'm not saying I personally make $117,000 a month in 2 years. But a bulk of that is owned by Cody and I, and we split it 50-50. So you could do some of the mental math there. We built quite a massive base of cash flow in a very, very little amount of time just by buying a little bit bigger. So 38 was a huge challenge. I loved that. Cody started with a 12-plex. His second deal was a 12-plex as well. Third deal was a 6-plex. When I met Cody, he was 21 years old with 30 multifamily units. That is a fantastic deal size. 12-plex is not much harder to manage than a 4-plex, but it just happens to make about 3 times the money.
Yeah, that's amazing. And how do you come about finding a partner that you like? Like, for example, Cody.
The first thing you're gonna do is you're not gonna partner with friends and family. Avoid that like the plague. What happens is money will change your relationship, and I've seen partnerships where they've gotten way stronger, even with family members, because things went well or they handled challenges together. I've seen more of them where they fall apart and go poorly by a huge margin. But either way, it changes the relationship. So don't partner with a relationship that you're unwilling to change. Cody and I are fantastic friends. We're very close, as are so many of my other business partners. We're very good friends. We became friends by doing business together. Money has always been a part of the relationship, so the relationship does not change because of money things. That is just a life lesson I've learned. People say it all the time. 95% of your listeners are going to have to learn it for themselves because they're going to end up partnering with friends and family, and they're going to be like, oh, this is why people said not to do that. You'll find out. So that's what you're not allowed to do. How you find the right partner, to answer your question more directly, goals need to align. This is true for dating relationships, for friendships, for partnerships. You need to be headed the same direction. If I want to go here and my business partner Cody wanted to go here, for those who are listening on audio, I'm spreading my arms in different directions. But 2 people are going in different directions. There's going to be a point where you're going to have major conflict that you likely can't overcome. apply that to dating as well. You should be headed the same direction with a similar set of goals. Now, in a business partnership, they are not designed to last forever, and that's a mistake people make. What you want to do in a business partnership is you set a goal, you set your equity, how you're going to get there, you set all the parameters, and you don't change or renegotiate a single thing until you hit that goal. For Cody and I, it was we want to own 100 units within 2 years. We did it in 11 months, but the goal was let's get to 100 units and X amount of cash flow so that I can retire my wife from teaching. That was the target. We didn't renegotiate a single thing till we got there, and once we got there, we looked at our pieces and reevaluated. What we found is my wife left teaching and ended up working in our property management company. Now you have 2 people from the Christian Osgood family and 1 Cody Davis with equal equity, but we're doing a majority of the work because there's just more hours in the day between 2 people. So then we looked at the equity and I said, hey, Cody, I bought into one of his sixplexes. He loves that building. I was like, how about I trade you my equity in the sixplex for the PM company? And we moved the pieces around so it makes sense for everyone. And now with everyone happy again, we set the next goal. And the next goal is let's push to 250 units. Well, I'm 99.9% sure we're going to hit that this year. I'll just say 100%. We're going to hit it this year. We're at 200. We started the year at like 110. We'll get there. We'll get there. So as we're setting these goals, though, we set a new target. And Cody and I will not renegotiate a single thing till we get there. I know Cody wants to buy some more stuff in the Midwest. So once we hit 250, we'll look at it again. We'll say, hey, do I want to join on some of those projects or do we do some solo projects? But that is the best way I've ever seen to manage a partnership is set your goals, change nothing, renegotiate anything. I don't care if you guys get frustrated with each other. You made a commitment to hit a goal, hit the darn target, and then just do a company meeting and figure out what the next goal is if you want to change anything. It is easy. It is simple. It is fairly stress-free. And Cody and I have had a heck of a partnership. Millions of dollars stuff in a very short period of time, which I'm very grateful for.
That's amazing. Congrats.
Thank you.
Now that you're in this, for the person that wants to pick a market, how do you pick a market?
So number one, population growth. The 80% of it. What is your product? This is for business in general. What is your product and where is your market? Housing for humans. Econ 101. I'm putting roofs over heads. I know I love providing great spaces and all that, but we're just talking about the economics of the market. So housing for humans. So I want to invest in somewhere where humans want to live. So I'm looking at, I like worldpopulationreview.com is actually fantastic by city or county because it shows you, the first thing it shows you is a graph of population growth. So if the graph is going up like this over time, which all of our markets are, people are moving there. I'll look a little bit at the construction pipeline because I don't like places where they overdevelop multifamily. So I usually am investing in places that have a little bit of a housing crunch while having a high population growth. But basic supply and demand, that's the number one thing. Then secondarily, we look at stuff like job diversity. We invest in Grant County, Washington. A lot of people are like, what the heck is a Grant County, Washington? The middle of the state, cheapest cost of power in the U.S. Because it's all hydro. They have employers are just like, we have a bunch of small companies. You have Microsoft, Amazon, Boeing, who else is the big one? Intel has a huge thing out there. You have data centers everywhere because of the power draw. You have aircraft R&D. Again, cheap power. You have some of the largest battery manufacturers in the world have moved there. And then historically, it's been an agricultural town. There's a huge agricultural base. So I'm looking at that. I'm like, okay, population's going up. Construction's having trouble meeting demand. There's job diversity, and they're all stable, either entry level or fairly high paying jobs. To me, that's the perfect market. The only thing wrong with it is it's in Washington. Washington laws around landlords are stupid.
Yeah. So thank you. We have population growth, and for construction is not meeting demand.
Yep.
And then there's a lot of jobs that are high paying. Good.
Yep. The ones that, the cities that scare me are like nothing wrong with military-based towns. I have a lot of people who love military housing. But if that is like the sole employer there, bases do move around. There's a few that don't. Like you have some massive bases. I actually invest in, I have a property in Bremerton, which is like the main nuclear naval base on the West Coast. We're not going to stop decommissioning and recommissioning nuclear subs out of that location. It's set up too specifically. So I'm not worried about that one. But there's a lot of bases where we move personnel around. Population will go up and down there, and it has nothing to do with economics. It's all military. So things like that, or areas like Detroit is a perfect example. They were driven by the auto industry, period. And when that industry took a dub, the entire city collapsed. I try to avoid areas like that because you do not want a single employer or very few employers determining your entire market. Companies do go under.
Yeah. So make sure that whoever is the employer there is there for a long time, not for a short time.
Yep. And then there's more than one. It's not just the government. It's not just a college. It's not just the auto manufacturer. It's, it's a few different companies doing things over a long period of time.
Yeah. That is great. I think we have a whole overview of what to do. What did you use to learn real estate and get your information?
I learned from the people who've done what I wanted to do. I mean, that's the thing. I looked at who owned that 38-plex. How did they get here? In our city, who owns the most multifamily properties? And then I just met with them, and I went, "How the heck did you do this?" I'm stuck on. I got stuck on 4 duplexes for a while, or not 4 duplexes. Sorry, 4 units, 2 duplexes.
Yeah.
My question was, okay, you have hundreds of units. Where did you start? And most of them started from 0. And I'm like, so how did you build this? And most of them utilized seller financing. All of them learned on their journey to buy bigger deals. And you learn these things. And when you go to promote, say they go, hey, I'm interested in selling my 15 unit. Cody and I are buying a 15 unit from one of those people right now. When they call us and we put together the deal, we just propose exactly what they taught us. And they're like, of course they're going to say yes, because they taught us how to play the game and what to propose and what worked for them. So when we go, they're like, hey, we're at 20% down. I'm like, well, I can do 10. They're like, oh, shoot, that's what we would have done when we were your age. I'm like, I know, you told me how to do this. They're not going to reject an offer when they taught you how to make the offer. And they're like, oh yeah, this is exactly what we told you to tell us. That's how I learned the game. I learned it from driving around. I don't know why they all own a truck, but you meet them, you get coffee, and then at some point they plop you in your truck and they drive you around their portfolio. They're like, this is exactly how I built it. And that's how I learned. It took a lot of hours. When I started, I couldn't find there was no great course on how to do seller financing simply. There's all sorts of like, wholesale your way here or become a broker and save your commission. Like, there's a whole bunch of like roundabout ways to get there. We had to learn for ourselves. Answer how to own it. Answer how to never lose it. Fix your variables. Buy real estate. It's that easy. And once you understand that and you practice it a few times, you see a deal, like someone can call me on a deal, I can offer on it on the phone call. I don't need to sit down and underwrite more things. Tell me what it is I'm buying and where I'm buying it, and I can make them an offer that's going to work for everyone before we hang up the phone. You just practice a few times, you get really good at it.
Yeah, that's amazing. So let's practice. How would a call that you have with someone go so that you can go ahead and make an offer on the phone?
Okay, so usually someone I have a relationship with or I have a referral to, because I don't ask for transactions. So someone brings up a deal. Let's take this 15-plex, but perfect example. They want $1.4 million for it. It's probably worth $1.3 million. That's fine. I don't have a problem with price as long as you get terms. That's why I love creative finance. Price is one of many negotiables and is probably the least important. So they call, hey, I want to move this for $1.4 million. We're ready to move this thing. We would like 20% down. What do you guys want to do? It's like, well, I could do 150 down right now. 150 down works for me. That's the thing. That's just over 10% down. That works for what we can do. Tell me a little bit about the property. They'll give me the details, because we're not going to dive into is it seller financed or how are we buying it. Yeah, they just they give us the parameters. So tell me about the property. Well, there's 15 units. One of them we rent for free to one guy. I'm like, okay, so there's 14 units of income. What are they renting for on average? They gave me a price. I was like, okay. So now we know the income, roughly. It doesn't have to be perfect. I know roughly what the income is. It's like, okay, so now what interest rate can we offer where it will cash flow day one? Because I know there's a bunch of upside. I think they gave us a number. I think average rent was like $650. In that area, for that type of asset, because I own the property on the other side of the street that's identical, we're getting leases at $900. So I know I can raise rents 50% here. So we can buy it at or above break even day one. And I know for a fact I can rent the same units at a higher price, literally the adjacent property on the other side of the street. I'm very comfortable buying this deal. We did so now we fixed our variables. I think we're doing, if I recall correctly, we're doing 6% interest only on this, if I recall correctly. It will do just better than break even. It will get them their price, but it's a 7-year term with an option to extend another 7 years, as long as we're in good standing on the loan. I think we pay them a nominal amount, like $50,000 in 7 years, and the loan extends. So I have a 14-year debt product at 6% interest only. It cash flows day one, and I have all that time to continue to get the rents up. I mean, we paid a little bit when we buy it, but the main thing is I'm going to actually cash flow quite a bit on this as we stabilize rents on this property, because I've done a bunch of properties like this. I know for a fact that this is going to be a 1 year to 2 year project. So I usually budget around 18 months. We're going to be fully stabilized, and away we go. Easy to make that offer. You literally go, okay, how much income is there, and what do I need to do on the project, and where does it cash flow? And then you just offer that. And if you're having trouble doing a bunch of math in your head, I love interest only. Interest only is a lot easier to do than doing a 30-year AM in your head. Cody can do it. I can't. He's memorized all the AM tables. So for me, I was like, okay, well, I know it works at 6% IO. Do you want to do that, or do we want to tweak something? That's it. That's an offer. We put it under contract. You do due diligence to make sure they didn't lie, and you're done.
Yeah, that is amazing. Yeah, very impressed in how you do everything just easily in your head.
Not hard math is the nice thing with real estate. It's easy to get overwhelmed, but you look at it, it always boils down to income minus expenses. That's it. So,
yeah,
you're out. On your first deal, you're going to want to give yourself an hour to break it out on a spreadsheet and look at it. Like there's going to be some amount of like, am I thinking of everything? The biggest thing I see people do that is a huge mistake is people think they need like 2 weeks to think about a deal. I see this all the time. That we run mentorship calls 3 days a week in our multifamily strategy program. So we'll see people, they present their deal, and then 2 weeks later, they're still asking questions about the deal. I'm like, have you not offered on this yet? Like, it was a great deal. Like, oh, I was making sure a few things. It's like an hour is way more than enough to look at the inputs and go like, I think this is a go. Let's get an offer in. Let's say yes. Time will kill your deals, especially if it's a good deal. Someone else is going to come in and buy that deal. An hour is more than enough time. Cody and I shoot for, on a good deal, when someone's on the phone with us, like no less than 5 minutes. I can tell you yes or no, but that takes some practice.
Yeah, that is impressive. Thank you. And when you're calculating the down payment, on your first deal, you didn't have the money to put it yourself, but you did get an investor. What kind of terms do you give investors, and do you calculate with the deal so that it still makes sense?
Yep. It's a great thing with creative finance. So first you negotiate the deal, then the debt, then the equity. DDE. Always follow that. Deal, then debt, then equity. Because if you figure out the debt and equity, you finance your entire deal. So start with the opportunity. I don't care what the financing is. I don't know if it's going to be bank, seller financed, whatever. I just need to know what the opportunity is. So you're going to start there. There are deals like our 38plex with millions of dollars of upside, and the cash flow sucks day one. I'm probably not going to raise debt because debt has a monthly payment on. And what you don't want to do on a property with weak cash flow is drain cash flow. That is how you lose real estate, which means you're going to bring on an equity partner who's going to participate in the upside with you. So Cody and I buy out all of our partners, except for each other. And even then, we occasionally buy out each other. But generally, the goal is to own the real estate. So if we bring in equity, it's because we have a lot of upside on the deal. And there's a lot of equity upside. It's custom to every deal. If there was a standard, which there's not, but on average, I tried to double. If the only consideration is equity growth, I'll try to double their money every 5 years. So if you bought in for $100,000 in 5 years, within 5 years, I will write you a check for $200,000 to buy you out. That's a pretty standard structure. If you're coming in as debt, and so it's private money and is lent, we're probably, when I started, raising me like 12 to 14%. I get a lot of money at 8% still, because we've proven that we know what we're doing and we are very good at doing our math and due diligence. People are comfortable with our projects, but somewhere between 8 and 14% is what you're probably going to be offering depending on the risk of the deal and the experience that you have. It's pretty easy. Lots of upside. It's going to cost you more in the long run to give someone equity every time. Equity is more expensive than debt, but you can't sacrifice cash flow. So that's why it's deal, then debt, then equity. If I can take it all out in debt, I won't touch the equity. If it's going to take me a negative cash flow, I'm going to bring in an equity partner. I'm going to get the value of the property up, and I'm going to buy them out at a later date, either out of cash flow, earned income, refinance, or some blend of the three.
That's amazing. Thank you. And for the person that wants to learn how to underwrite like you did, do you recommend any resources?
Keep it really simple. Almost everything I have ever read or studied is more complicated than what you need to do. Great resource is a free resource. We talk about this all the time on our YouTube channel. So you get Cody Christian Multifamily Strategy on YouTube. Literally, we just 3 days a week, and I go live every Wednesday, though I'm sorry I forgot this Wednesday. I've never done that before. So for listening, my apologies. But every Wednesday, we go live, we do 3 videos, and it's always on managing properties, raising private capital, what have you. We have a ton of videos on it, and we keep it really simple. I have a math video, most of them are 8 minutes long. I have a math video that's an hour long that literally goes through exactly how we underwrite everything. It's one of our first videos. That's a great resource.
That's great. I will recommend that everybody goes and watch that video so that they know, and then practice to do the numbers in their head so that they can make an offer fast.
And you also just you can be on the phone and just pull out the calculator app, because you're going to go, okay, what is the income and what are the expenses? And it's, again, especially if you're doing stuff with interest only, the math is really, really easy. And you could also be on the phone and pull up a basic Google amortization schedule. If they're like, oh yeah, we want to do this on a 30-year am. It's like, oh, excellent. So that's going to be this much per month. Excellent. Okay, I can offer you this. You don't have to do it in your head, but you should be able to do it in real time on a phone call. It's not a lot of practice with math to be able to do the basic add up income and expenses and figure out what your mortgage payment's going to be. Those are pretty simple math equations. If you pass 4th grade math, you can do this.
Yeah. How has being able to offer on the phone call been a benefit to you when you're getting deals?
It shows a massive amount of confidence when you can listen to a deal and adequately explain, and not just oh yeah, let's do the deal, but this is where the deal is going to work for me, and I can defend why. It's based on what you told me. We could make this work at this price, at this interest. We'd structure the loan like this, and I need a balloon of at least this long. I would like longer, but say it's a midterm project. I think I'm going to refinance in 3 years. I'll ask for at least a 5-year balloon. It's so Like when you ask good questions, you understand the opportunity, and you just go, okay, this is what will work. People are like, oh, okay, this is someone who knows what they're doing. That is the biggest piece of being able to just understand a deal and offer. Things can always be tweaked. We try very hard not to renegotiate, but sometimes you find out something in due diligence where you're like, wow, that is a massive change to the deal. But on a base level, you're not buying the property when you offer on the property. There is all sorts of steps and time that goes between point A and point B. Negotiate on the facts that you have, put together a great deal that you like, and the rest of it, you figure out the nuance along the way.
Yeah, that is amazing. Thank you. What do you do when you're talking to an investor that you want to meet and build a relationship with?
So the first thing is don't overtalk, and definitely don't overtalk about yourself. You want to communicate, this is who I am and my goal. And that takes like 30 seconds. Example. I'm calling, I have my first 2 duplexes. Hey, this is Christian. I just bought the duplex right down the street from your 12plex on Peninsula Drive. Like, okay, I'm not selling. Awesome. I just spent all my money on a duplex, so I don't even know how I would buy it. I did have a quick question for you. I wanted to get to know my property neighbors. More importantly, I'm doing this one duplex at a time, and I'm not getting closer to hitting my goal of retiring my wife from teaching. I'm trying to figure out how to buy assets that are in the 12 to 30 unit range. I was just curious how you got started. Did you get started with the 12, or is this something that you scaled up to over time? And at least half of people are happy to engage because you're not trying to buy their stuff. You're just asking. It's like, hey, I'm asking for a little bit of help. Most of their family don't care about their business story, and they love telling it. So they'll reach out, they'll talk to you. And then when the energy's high, they've told you a little story. The other mistake people make, other than over talking about themselves, is they talk too long, and then you're like, hey, can I meet? And they're like, well, what else do you want to talk about? You're like, oh, shoot, we've already talked about everything. Get some energy going, and at like the peak of energy in the conversation, be like, okay, this is really exciting. I'm going to be in town in 2 weeks. Are you local to the property? I would love to buy you coffee because I want to hear more about this. I make, on average, 5 calls a week. That's it. Like I make 1 call per day on the business days. Of that, I get at least 1 coffee meeting scheduled. So I meet with 50 owners in my markets per year. And all of them know my 30-second spiel of, this is what I'm trying to do. I don't have a lot of cash. I have a good deal of real estate. I am trying to expand. I am trying to learn how you did what you did. And the rest of the conversation is about them. I am the first person that they think of when they go, oh, shoot, I need to sell this. Or I have a friend who is selling this deal, and I know they're willing to do seller financing. I know Christian doesn't hold a lot of capital because he's always buying properties. And I get a text saying like, oh, you need to check this thing out. Then I'll call someone and go, hey, your friend said I need to check this out. What's going on? It's like the most passive way to have deal flow ever. And again, Cody and I close on a deal like every 45 days. And that's not offer. That's we close on a deal every 45 days.
Yeah, that is amazing. And the fact that you're talking to investors really puts you at an advantage because they're in your area, they're in your demographic, and you're able to use them as help, reach out to them.
It's a team sport. I use a lot of board game analogies, like a lot. I play too many board games. That's my one vice. It's, if you're just playing by yourself, you're going to be very, very, very limited on the moves that you have. If you're using your own money, you're only using banks. You're not getting a bunch of help or building a network. You're going to be very limited. You're going to end up like I started with a couple duplexes, and that's you're going to be kind of limited there. As you start to network with other people and work together with them, you're solving problems for both parties, which one is really fun. It's a great mental exercise, and 2, you end up buying quite a bit of real estate. Well, when people are like, hey, I'm trying to move this asset, but I'm trying to do it with, say, for example, I'm trying to pass I want to pass an income stream to my kids, not a bunch of cash. And my kids don't want my real estate. Easy to go like, okay, how do you want to structure the terms? Like, what do you want that annuity to look like to your kids? Let's write a deal that gets you towards that goal. Now you're solving for them. You're taking it You're taking their problem, they get a cash flow problem, and you're buying a property, low to no money down on your own terms that work for you. That's a simple solution. It's fun, and everyone wins. The seller wins, your investors win, you win. It's a very simple, fun process, but that is what the network does every single time. And you're just building opportunities.
Yeah, that is amazing. All right, Christian, for people, where can we find you?
Easiest way to message me is on Instagram. I'm at Christian Osgood. My business partner, Cody, is doing Cody things. You can check him out as well. But message on Instagram. I'm super responsive there. You can check out our YouTube channel, Cody and Christian Multifamily Strategy. And if you want to take a deeper dive, we have a website, multifamilystrategy.com.
Thank you, Christian. We really appreciate the podcast, and we hope to have you on in the future.
Absolutely. Thank you for having me.